Here's some investing keys that are focused on dividends, which is one of the most crucial elements when it comes to investing and building your wealth. So what is a dividend? A dividend simply is an amount that is given back to any stakeholder with cash that is left over. So essentially profits given back to anybody that's invested in the company or works for the company. When a business decides to pay a dividend, it is simply a management decision on what to do with the excess cash that is left over. It doesn't really determine the company's growth levels, whether they're going to be slow or fast. To come to the point where a business is deciding if they will be paying a dividend, they've matured to a level where they have constant stability, but they're still profitable. If they are not profitable, there's no way they would be paying a dividend. Now, over time, even a dividend-paying company can fall off a little bit and start losing their margins, their profits, so they can trickle back on their dividend payments, and that's usually a really bad sign. But if a business decides, hey, we're going to start paying dividend, essentially there are some guidelines depending on which industry you're in, how big your company is, what the timeline is, and overall deciding that we don't want to invest in anything that's innovation related, that is in CapEx, that is in purchasing equipment or purchasing new facilities or hiring more. Instead, we're going to take this money and give it back to our stakeholders as a cash amount. For institutional investors and for passive investors, it should be known that dividends are not really good or bad for the health of the business. It's just a simple management decision, once again, that's been made to do with a percentage of profits. But it does not really give you substantial fundamental analytical understanding of if a business is successful. Now, once again, if the dividend gets retracted over time, if a dividend shrinks over time, then yeah, that's a bad sign. Or if a dividend is growing over time consistently for year after year and defeating inflation on top of that, that is a great sign. So dividends are deducted from equity, since most businesses, when they pay dividends out, they pay them as a constant percentage of the surplus. Dividend paying businesses vary in all formats and shapes. There are even entire ETFs that you can invest in that pay out a large sum of dividends, or dividends depending on a complete different style of investing, whether it's passive, active, long-term, focused on industrials, focused on tech. You can find ETFs specific to having a dividend base in any sector and any industry. One of the best strategies for anybody, especially those that are starting off young and with a small amount of cash, is to constantly reinvest your dividends back into the stock that is giving you the dividend. This compounding factor gives you exponential growth. When I look at dividend stocks or dividend ETFs, I look at how much they're giving back, and I always reinvest as much as I can. So dividends are a value proposition. And trust me, anything that is giving you value, you have to pay taxes on. So don't ever forget that. With dividends, that's the one L you do take, and that's one thing a lot of institutional or really big investors don't like about them, because they're like, take that cash, reinvest into company, and buy back stocks. That's going to give you more value growth. So that's the other side of the coin. But essentially, since it is a value proposition, you look at currently the assets, the cash flow, the dividends, and the depth of the business to figure out like the value. And essentially, that's why dividends are part of the value proposition. So when you're looking at the value of a dividend stock, you really have to look at the yield. You have to look at the fees. You also have to look at if this business is going in any type of loss or has a lot of debt, where over time the paying off the debt will be more important than paying off the dividends. So management's going to have to make that pivot or that decision. So those are the things you really want to evaluate. And then there are some established dividend analysis formats out there. I don't want to get into too much detail of that, because I'm just trying to give you a basic understanding with a little bit of analysis where you still get great information. You don't have to do something long term. So essentially, looking at that factor, you want to do an analysis on all those little things to get the real value out and maybe exit sooner than you would want to. To analyze a dividend stock or a dividend ETF effectively, you have to look at it through the lens of growth, valuation, and sustainability. That's how you find the right play. The final simple analysis is to compare the total dividend cash paid out against the company's free cash flow. If the free cash flow doesn't cover the dividend, the company has some issue, whether it's diluting shares to pay you, borrowing money, doing something illegal, who knows. There could be any issue, but that is one simple analysis that must be done. Then a static dividend loses purchasing power to inflation over time. You must always remember that. You want a company that regularly increases its payout. The dividend quick check framework, when filtering potential tickers, run them through the mental matrix. High yield plus high payout ratio, often a value trap. Capital depreciation can easily wipe out your dividend gains. Low yield plus high dividend growth, often a compounding machine, great for total return and long-term wealth building. Investing in dividend-based stocks or ETFs is basically a personal decision. Each investor looks at it differently. If I'm at my retirement age and coming closer to that phase, I would love to have more dividend stocks because I can take that cash, put it in my pocket, and use it. Or if I am somebody who likes a well-balanced portfolio, you can invest in value and growth and dividend stocks that are just value. So there are a lot of value stocks out there that don't give out dividends. But if you can establish a well-balanced portfolio with all three factors, then go ahead and do that. Here are 3 investing experts and leaders that you must know. First, we have Darren Acemoglu. Second, we have James Robinson. Third, we have Kai-Fu Lee. Darren Acemoglu and James Robinson are both exceptional economists who wrote a book together called Why Nations Fail. This book is world-renowned, one of the best-selling books when it comes to anything related to the economy. They've even won a Nobel Memorial Prize with partnership with Simon Johnson for their foundational research on how societal institutions shape a nation's prosperity and wealth. And majority of their scholarship actually focuses on political economy and institutional development. Now, Kai-Fu Lee, he's legitimately a legend, a living legend. This guy's worked at Apple, Microsoft, Google, both in the US and in China. His resume is literally unparalleled. He's an inventor, an investor, a venture capitalist, an AI leader. He's developed generational wealth and worked with generational entrepreneurs for the last 20, 30, 35 years. He's literally one of the creators of voice recognition systems that worked on speech and tone. He was the first to literally do this in college. And then he worked his way up through a lot of tech companies in Silicon Valley. And then after trying to develop them here, he went to China and did it. And then after years of dealing with the government there, dealing with the bureaucracy of the companies, he decided it was basically trying to focus on venture capital and separated himself over time and focused on China. And he's created a lot of wealth there, just like how he did when he was in the US. And here are 2 quotes from Kai-Fu Lee that I feel like everybody should listen to kind of get an understanding of the depth of his mindset. He is an AI leader in China. He's one of the first people to see AI becoming what it has become and how much further it will go. So the first quote is related to that in more of a philosophical sense. AI ever allows us to truly understand ourselves, it will not be because these algorithms capture the mechanical essence of the human mind. It will be because they liberated us to forget about optimizations and to instead focus on what truly makes us human, loving and being loved. Even though being an AI leader and somebody who believes that AI will be one of the greatest inventions in the face of Earth, he still has a philosophical element to how he sees it developing and getting to the core of humanity alongside this technological advancements and going back to what we originally, should be doing, which is loving each other, caring about each other, and not stressing over work and productivity and things like that, focusing more on emotions. Here's the second quote. China's startup culture is the yin to Silicon Valley's yang. Instead of being mission-driven, Chinese companies are first and foremost market-driven. So Kai-Fu Lee has drawn a clear line separating Silicon Valley from China. He's saying China focuses more on market, more on the numbers, more on developing just a bunch of products that everybody can use and consume. Where in the US, there's always some type of mission statement. There's always some type of bigger outlier reason why they're working on stuff. So he's saying China's obviously more technical, where the US is more emotional, which in comparison to his last quote, which talks about AI coming along and us going more closer to our emotions and love, you see the separation of where he is and what he's saying and being in the US, so maybe that influenced him. The Fed is essentially stuck. That's what the data and policy stances are showing right now. Overall, the condition that we're in is all because of the war confusion right now, which originally was a tariff confusion. Luckily, the Supreme Court ruled out tariffs. So now the war is what's putting a lot of pressure on the Fed. It's basically a fresh wave of supply side inflation while managing internal and institutional friction. Once again, Trump's cabinet is roughing up the edges for institutions in the United States. Both the PCE and CPI warmed up, which are the Fed's preferred metrics. Essentially, core personal consumption expenditures price index rose 3.2% year over year through March, up from a low of 3% in February. Headline CPI printed at 3.3%, with core consumer price inflation currently sitting at 3.8%. Input cost pressures. The Fed's latest Beige Book highlights widespread input cost pressure tied directly to elevated fuel and logistics costs. The silver lining, shelter and housing costs increased by a more moderate 3% over the year. The Fed anticipates that cooling housing data will act as a lagging deflationary force, helping offset near-term energy headwinds. I mean, shelter and housing costs, I feel like that's always a soft spot. You want people to be able to afford where they live and how they're maneuvering. And when they get to the age to buy a house, they should be able to buy a house. None of that is possible right now. So even if rents are cooling, it's going to affect the landlords. So either way, somebody's getting hurt in this proposition. Now the economy, somehow it's maintaining well. And I'm not even going to say somehow, because my analysis, which was in my last video, showed it's all due to the wage gap and how much the wages are growing for the wealthy and how they're stagnant for the middle class and lower class. So I believe it's directly tied to that. And I feel like there's going to be more research coming out that's going to be proving that. I mean, there's definitely momentum in the economy, but logically and how these supply disruptions are going to start hitting us, I don't think it's going to be something that's strong enough to be relevant for the next 6 months. Through the benefits are highly fragmented. Recent data shows that U.S. industrial and manufacturing output just hit a 14-month high. And New York manufacturing activity saw its sharpest rise in over 4 years. I mean, those in the lower income bracket, their purchasing power is just deteriorating with these high gas prices. And then, once again, these high gas prices are going to affect the rest of the economy. So it's only going to get worse. It's like a snowball effect. And we've seen this happen in previous recessions. All the data that's coming in on gasoline purchases and consumption, it's all looking shaky, and there are shifts in it already. The job market is seeing some growth in it, but it's not good for great jobs that people want coming out of college, jobs that grow in wages, jobs that have some type of upside to them with promotions or certification. Those are lacking. Now, yeah, you can find a great job being an electrician just because data centers are growing. You can find construction jobs because the data centers are growing, CapEx is spending. But once again, the broader economy is seeing signs of weakness in jobs. Now, as far as people coming out of college, with the first quarter employment rate of 5.7% and an underemployment rate sticking at 41.5%. And recent college grads, they're having all types of issues, whether it's applying for jobs that are AI or so-called ghost jobs, which employers are just listing and putting out just to see how many people they can attract, but those jobs don't even exist. Now, stocks for the week of May 11th to May 15th, 2026. All the way through Thursday, equities were hitting all-time highs and new records. It was all due to the earnings reports and the data that was explosive when it comes to manufacturing. The combination of the two, we thought we were going to just keep booming, going all the way to the end of the month. Now, once Friday hit, we got the CPI and PPI report, which were hotter than expected. We saw a reversal right away. And the realization of the energy shock that we're about to face created a dramatic surge in bond yields. Basically, the number was the 10-year Treasury breached 4.59%. This punished rate-sensitive small caps and prompted heavy profit taken in high-flying AI and semiconductor stocks. causing the major index to slide into its weekly finish line. So we were seeing great upside up until Thursday. We get this news and this thought process analysis of, hey, there is an energy crisis. Boom, everything flips, reversal hits. So the S&P 500 was up 0.13%, Nasdaq Composite was down negative 0.08%, Dow Jones Industrial was down negative 0.17%, Russell 2000 was down negative 2.42%, crude oil was up 4.44%, gold was down 2.22%. So we have to focus on the financial sector because it's been getting beat down lately. Stocks like Robinhood, SoFi, they're not looking too good. We already know the private credit market has some issues, which is also correlated to this. Essentially, we have to kind of compare it to the S&P 500, which is now below the great financial crisis, now in COVID-19 lows. Stocks like SoFi, I actually went ahead and made an option call long term because the fundamentals are looking great. It's all due to the Fed decision and other macro and geopolitical issues. And SoFi, once again, is going to continue to grow. Yeah, they might get higher interest rates that they have to deal with longer than they thought, but I think it's manageable. And once they start doing business accounts, I think there's just nothing but upside. For Robinhood, I think where it's at right now, I think it's a great value long term, especially if you're going to go in for 5 to 10 years on it. There's nothing but upside. This is not investing advice, it's just what I'm doing and sharing. So now we have to talk about US and China and the Iran war. Once, it was solidified, Trump is going to fly out to China and figure things out. Market was looking good. His arrival there, people seem positive. Chinese people seem positive. The Chinese government seemed extremely open to doing business with the U.S. U.S. at the same time was reciprocating what China was saying. But we know the issues exist, and it's hard to make these deals on singular trips. It's a long negotiating process. But at the same time, when the market didn't hear what they liked, that was also part of the portion why stocks and bonds took a hit. The other part why market didn't like it is there was nothing major said on Iran. Essentially, people want this war to stop right away. And this trip, that was one thing people were really hoping some dialogue will come out, some statement will come out, which gets us closer to the Strait of Hormuz opening, even if Iran starts taking some payments. Essentially, we need the supply to get back on. And this discussion with Xi and Trump does establish some type of ground for Iran to feel comfortable enough to move forward. They can't trust the U.S. They'll never trust the U.S. It'll be dumb for them to trust the U.S., but they have to negotiate and work with the U.S. and China. So that's what we're hoping out of it, and I really believe we do need to take steps forward, and hopefully China can be the adult in the room and make this happen. Now I have to discuss what I think about with Trump taking all these CEOs and entrepreneurs with him to showcase to China that look what we have. I honestly think it made the U.S. look so much weaker than anybody can imagine. The way the Chinese government looked at Trump with all those people there, he's like, are you serious right now? Do you know how our government functions? Like, we don't give a shit who are entrepreneurs, how much money they're making, what they're doing, as long as they're not focused on our system and our society. We don't give a shit. So for you to bring these entrepreneurs part of your delegation makes you look weak, that you don't have enough capable politicians, enough leaders that should be front-ending these type of meetings. Like, who are you? That's how China looked at it, and that's how I'm looking at it too. We can't be going on these delegations with our entrepreneurs and CEOs who are people essentially that shouldn't be so intermingled with our politics in our politicians' pockets. Now, what's funny about this whole thing is, at the same time, that's how I'm viewing all these entrepreneurs and CEOs going with Trump. But I'm also kind of happy that they were there because there was some level of intelligence in those meetings and in those rooms. Because if it's just Trump and his delegation, Xi and those guys will outsmart them, outwit them, outmaneuver them on every angle. I think these CEOs and these entrepreneurs are definitely more intelligent, more capable, more analytical to be in those rooms, but that's not how our government and politics should be functioning. It just doesn't make any sense. We need to get more people into politics that have a versatile and diverse understanding of things, where we're not sending our entrepreneurs and CEOs on these delegations to engage with other governments. Let them come here and meet those guys so they can really get an understanding of what they do and who they are and how much growth they can develop. Essentially, China has the same front, you won't see them doing these type of things though. This type of like front, this type of acting, this type of like reality TV.